Good afternoon. This is Sean Golding with Golding and Golding, here to discuss the basics of the U.S. tax on an Australian superannuation. Australian superannuation is a form of foreign pension plan. It's very similar to a 401k, but it has some aspects of Social Security. Generally, it works similar to a 401k in that you may receive pre-tax contributions from your employer that go in there, different tax rates depending on the income level of the employee. There's voluntary contributions that can be pre-tax or post-tax. So it's more complicated, and it's meant to be more complicated than the 401k because it's compulsory, whereas a 401k is not necessarily compulsory in the US. A common question we receive from our Australian clients is, what do I do with the super? Maybe they were a US person who was working in Australia and receiving contributions into it. Conversely, they became a US person later and now they've got the superannuation. They don't know what to do with it. The IRS doesn't have a specific position, bright line test to tell you exactly what to do. So we're going to give you what we do here, which is generally what it seems like most experienced practitioners do. The first are the contributions, and typically the contribution pre-tax from the employer into the super is going to be taxed. With a 401k in the U.S., for example, it's not taxed. Different countries, the U.S. has said that the contributions are taxed, even though they haven't specifically said it. For this, I mean, there is no exclusion in the tax treaty. If you look at the tax treaty with like the UK, there's an exclusion that I think it's Article 17, if I remember correctly, and it basically says if a U.S. person is working overseas in the UK for a UK employer and certain money up to the exemption amount in the U.S. is being contributed to that foreign pension, then the U.S. person can take the deduction on their U.S. tax return, same way they would like a 401k. That's not written into the treaty with Australia, so it might be a stretch to say that the contributions are not taxable. When it comes to the growth, our position is, hey, there is a treaty with Australia. Until that money is distributed, until the person covered is receiving distributions, it's not taxable. Now, the IRS could come back and say, hey, we think it's taxable, but we do not believe it would be a frivolous or unreasonable position to say it's in there, it hasn't been distributed, it's a treaty country, it's not taxable until it's distributed. Another common question we receive is, before that, distributions. Generally, distributions are taxable. You have to look to the treaty to decide, what country the person's living in and whether there's some exception, exclusion, or limitation when they're receiving the distributions. You may be able to make a treaty position if necessary. The 8833 has several exceptions to it, so you may not need to actually file the form if you're making that position. The other question we get oftentimes is, how do I report this thing to the IRS? Generally, it's reported on two main forms: the FBAR, Foreign Bank Account Reporting, aka Foreign Bank and Financial Account Reporting, technically referred to as FinCEN Form 114, more than just bank accounts. The super is a type of account for FBAR purposes, and since it's not specifically excluded by the IRS, then it would be reportable. Now, FBAR is a FinCEN form, Financial Crime Enforcement Network, developed back in 1970, but it began enforcement by the IRS in 2003. The threshold requirement is if on any day of the year the filer has an annual aggregate total of all of their accounts combined, not each account, including supers, or any foreign retirement pension plan or account that exceeds $10,000 in any given day of the year, then it's reported. There's also FATCA, Foreign Account Tax Compliance Act. Australia and the U.S. entered into a treaty. U.S. has entered in more than 110 treaties. It requires reciprocal information between Australia and the United States. The super would be reported on the Form 8938, which is the form individuals use to report FATCA. There's different thresholds, unlike the FBAR, which is one threshold. For Form 8938, there's several, depending on the filing status and the country of residence, whether it's U.S. or foreign. To give you an example, the single person in the U.S., $50,000 on the last day of the, or more than $50,000 on the last day of the year. If it's under $50,000 on the last day of the year, using that same aggregate annual total concept, but more than $75,000 on any given day of the year, it's reported. Likewise, if the person is living overseas and they're married filing joint, The 50 jumps up to 400, the 75,000 jumps up to 600,000. So there is a difference. Some practitioners report the superannuation on Form 3520A as an apple, which is mainly used for grantor type trusts. We never did it that way. It's always our position that that's not what the IRS is talking about when they're talking about trust. They're talking about grantor trust. They're not really talking about employment trusts. So the 8938 and the FBAR should be sufficient. In March, I believe, late February, early March of 2020, the IRS issued a revenue procedure, kind of known as a RevProc, and the RevProc was 2020-17. The RevProc said, hey, you don't have to do the duplicate reporting, 3520A, for these various types of trusts, tax-deferred trust, retirement tax-deferred trust, and why they don't identify each and every type of foreign pension plan that could be considered a trust for reporting purposes without this exception, the super falls squarely in it. So the position would most likely be, or presumably be, that you don't have to report the super on 3520A. Technically, there's nothing wrong with doing it. It just seems like duplicate reporting. In fact, if you use somebody and they reported it on the 3520A and late, and then you got hit with a penalty under this revenue procedure, you can avoid the penalty. You can get it abated or waived if it's already been issued. Are there penalties for not filing timely? Yes. The IRS can issue penalties for FBAR and for FATCA, and those penalties can be severe. Generally, if you didn't know about it, you're not going to get hit with willful penalties. The FBAR non-willful penalty ranges from a warning letter in lieu of penalty to a $10,000 penalty in total, to a $10,000 penalty per year, to a $10,000 penalty per occurrence per year, up to 50% value, total amount of money. Generally, it's going to be a $10,000 total penalty or $10,000 per year penalty. The Form 8938 penalty is a little different. It's a $10,000 penalty, and then if more than 90 days go by, you start to rack up the continuing failure to file penalties that can reach $50,000. How do you avoid the penalties? You do one of the voluntary disclosure programs. They did close OVDP in late 2018, but they expanded the traditional voluntary disclosure program in early 2019. So if you were willful or you're unable to certify under penalty of perjury, you're non-willful, that would be the program for you. There's also the streamlined domestic offshore procedures, streamlined foreign offshore procedures, delinquency procedures, and reasonable cause. Again, my name is Sean Golding with Golding & Golding. We have tons of free information on our main website, goldinglawyers.com. We have a sister website, IRSstreamlinedprocedures.com, for issues related to the streamlined filing compliant procedures, domestic and foreign. Thank you for your time. Enjoy your weekend.